Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro, technicals, and crystal ball gazing. Today is Thursday, December 19th, 2024. Today's episode begins with GDP Quarter 3 second revision coming out and initial jobless claims, both coming out with very strong numbers. The right column is the last reading of this, the middle is the expected, and the left side is the actual numbers coming out with initial jobless claims last 242,000, expected 230,000, and the actual 220,000, lower initial jobless claims than expected. In the GDP second revision, we rarely get a revision that goes up by 0.3%. This is a big move. In GDP being revised higher. This adds to give a little bit of credence to Powell for his hawkishness. I mean, these aren't weak numbers. Why are we cutting? And, the market's sort of rightfully asking that, but at the same time, we're just at that part of the cycle. It's just where we are right now. Again, for details on the macro view, always watch Monday's show for this week. It's titled Friday 13th, and it has a tornado in it. But based on this data alone, things seem just perfectly peachy. With that data coming out strong and Fed Powell saying, hey, we're going to be more careful with our cuts. Fed funds futures now prices only one more cut. This December cut, this is the level, 425 to 450. This is the target that we're currently at. We're looking at one more cut in not until May, and then that being the terminal rate. And that's what the market's currently pricing in. If you've followed financial markets or know much about financial market history, that's not typically how it works. Typically, when you start the cuts, all of a sudden things roll out of control and the Fed kind of has to catch up. And after all, when monetary policy eases, you don't typically see the effects of it for as long as an entire year. And so it's really a silly game of chicken, really, with the markets and the Fed like driving at each other to see who's going to, turn off the road. And it always ends badly. It always ends with emergency cuts and the sort, but we're not there yet. It's not happening yet. As I said yesterday, maybe a market crash is the black swan that we're kind of waiting for, that may be the thing that gets everything spinning out of control. It would not be surprising to really anyone at this point for it to play out like that. There were a lot of interesting developments in charts, and we will go over those when we get to those after. That's the third part of the show. If you've been following, we do our agenda first, and then we do my daily reminders, and then we do the charts. Next thing on the agenda, though, for now, is the debt ceiling and TNX. Headline from CNBC, Trump endorses House GOP deal to avert government shutdown, suspend the debt ceiling, and Trump calls for abolishing the debt ceiling. Now, while TLT in pre-market today, before this news came out, was already down, I was thinking okay, maybe the bulls will come in and, buy up longer dated treasuries, as it would make perfect sense for every reason under the sun for that to happen. Pretty much me and every other analyst out there is scratching their head a little bit trying to figure out why the 10-year note yield is going higher right now. The strong economic numbers, and then this on top of it, this may have reduced the amount of potential bullishness that may have arisen today in the bond market, and this may have canceled that. Oddly enough, abolishing the debt ceiling means that there's less risk of, defaulting. Not that there is any risk of defaulting at all, but yeah, it opens the door to perhaps more fiscal spending and, runaway in that end, which is not good. But, on the other side of this, while the 10-year note yield is rising, you still don't see higher inflation being priced in anywhere. Gold isn't looking strong. All of the charts are not showing strength in worrying about inflation still. Yesterday and today, with some follow through. Simply looking again at the 10-year break-even inflation rate, this is this predicts, this prices what inflation is going to be over the next 10 years. This is what people are betting based on Treasury inflation protected securities. These are issued by the Treasury that are protected by for inflation. What are investors willing to pay for the difference between the regular 10-year and the rate you can get on the tips? And this actually, it went down today while the 10-year is going up. It's like I'm really scratching my head here with long rates going up here. I don't understand it. I would think that it would reverse strongly tomorrow. That's my take on it right now. That's all I can say. Just a quick reminder, the Santa Claus rally is supposed to start next Monday and go through the 2nd of January. That's the time when the traders supposedly kind of go home and the retailers pretty much don't short, and so the market kind of just gracefully floats higher. The charts are bearish as heck, right? Looking really bearish right now. I'm really wondering with me and my crystal ball if the Santa Claus rally is really is canceled this year. As I said on a previous show, if the Santa Claus rally was going to be canceled in some year, I would think this would be it. The 3-month 10-year reverting, it was just this past Friday. This is it. This is when the stuff hits the fan. It's here. And yet it isn't, right? The GDP number getting boosted up, the initial jobless claims still looking honky-dory. I don't know. Also, last thing on the agenda later this week, well, really just tomorrow, Friday, we still have PCE data to come out, and this is the Fed's favorite inflation gauge. With them being so hawkish, I almost would expect these numbers to be higher than what the market currently thinks it's going to be. It will probably be interesting. Maybe not. I don't know. We'll see. Two of the daily reminders shifted a little bit. The CAPE ratio was at 39. Now it's down to 37 with the market basically crashing here a little bit. And the PE ratio of the S&P 500 dropping from 31 to 30. Minor move, but overall, no other daily reminders have changed. Again, watch Friday the 13th. Is the name of the title, and the tornado and the ball to hear me walk through the daily reminders. These are just incredibly important things for any serious investor to have in the back of their mind. Even though I don't read through them every day, these are things that I think need to be thought about every day. With no changes in the daily reminders, the crystal ball ratings also remain the same. Again, watch Monday's show to hear me read through that along with my portfolio. On to the charts. I actually wanted to start with a TNX today. I usually start with the S&P 500, but this is just so important. I wanted to start with it today. I adjusted this line. Look, you can move it, right? This is the 10-note Treasury yield. If you've been following the show, this is like my favorite pattern, the top of 21, connecting to this neckline here on Head and Shoulders top. And, it still looks pretty valid with a number of adjustments. I'm wondering even if we can count this as bumping our head on the top now. A lot of good chartists are talking about the high in April being the next potential high target in, as far as chart patterns go as to where this might be headed in the very short term. Again, every analyst out there is scratching their head trying to figure out why rates are going higher. After all, if the Fed really is going to be tighter here for longer, it would mean that the longer yields should actually go down. And and funny enough, you look at the 3-month 10-year Treasury, how we reverted, and I was thinking too, is this going to be prolonged? Are we going to be in this stage where we go back into inversion and, prolong it and make the upcoming recession or depression even worse. And no, it's steepening. It's steepening the 3-month, 10-year treasury. The only way, um, what the market is essentially saying here is they're saying, okay, the Fed said that they're worried about inflation, so we should be worried about inflation. And so we should expect a higher yield on longer term treasuries, apparently. And yet the 10-year break-evens are going the opposite way as well. So there's some major divergences here. I can't expect long yields to continue higher from here. I'm flabbergasted by this. I keep repeating myself. Sorry about that, but it's yeah. I would expect it to roll over violently here. If the S&P 500 was going to recover in sort of a blow-off bottom, we would have seen it go almost up to the top of yesterday's candle. Instead, we see a clear bear flag forming, just a small bounce. If the bulls had strength, they would be buying in mass here, and they would be sending the price right back up. This is very bearish looking to me in the S&P 500. Just this little candle at the bottom of this large red candle. If that's all the bulls have right here, that's bearish. There's no other way to put it. And if we do get another continued leg down in risk assets, it rates will go down. They just will. The TNX, I'm just scratching my head. I don't know what's going on. Like I said, maybe the debt ceiling scared some of the potential bulls that were going to be buying today and didn't, but I already said that. The dollar continuing higher. Remember, folks, the dollar has been going up since September pretty violently. It's like this is just looking bullish as ever. The dollar simply looks very strong here, while your risk assets are looking weak. Again, with the yields going up, I'll stop. I already talked about it. I'm done talking about TNX. Very notably, the U.S. Treasury's yield curve. I love looking at this website because I can see what it looks like on the graph. Wow, this is like full reversion at this point. This is the point of the cycle where the recession begins. This is when the stuff hits the fan. This is it. We're here. It'll be more obvious week after week, I believe. As we see more black swans pop up, banks blow up, everyone losing their jobs. But remember, guys, I'm just a guy with a crystal ball. Another way to chart longer yields is, of course, TLT, the most popular long duration treasury bond ETF. As you can see, we're basically right at this previous bottom in the price of TLT, this which I believe is adjusted for dividends. I think this is not adjusted for dividends. Any which way about it, I noticed that it is at this other bottom, and other people will see this, but this is a small piece of the puzzle, perhaps not very valid. I'm short junk bonds. I own long dated puts, and this is looking very, very bearish. Again, large red candle. If the bulls were going to come in and buy it up, I believe it would happen here. We didn't see that today. Also, home builders XHB index dropping another 2% after a large move down. This is like accelerating to the downside. Look at that. Incredible moves down in home builders. Again, this has to do with the rates long duration rates going up don't help this at all, obviously, as mortgage rates are expected to go higher when long rates are going higher, obviously. So that's a part of it. Another big development in chart patterns is actually in copper today. I noticed drawing a very carefully drawn neckline has the neck from February 24 to August 24. We have a very clear head and shoulders top, and we broke and confirmed today to the downside, suggesting copper is headed lower. And Dr. Copper with a PhD in economics, if this is showing weakness, and as this chart is looking very weak, looks like we're literally like watching the waves of the storm coming at us right now. Similar in silver, with a head and shoulders breakdown here and confirmation. So not looking strong at all. Bitcoin also straight up looking bearish today after yesterday's pretty big red candle today, hitting a bottom of 95.6 thousand. Oil, from a basic pattern standpoint, holding up above this breakout line, suggesting that there is likely still upside left in oil on a basic chart pattern basis. But again, these chart patterns, they have oftentimes like 70 or 80% probability of playing out. And so there's always that 1 out of 5 chances where it goes the other way. I'm kind of wondering if oil's done here, and we are headed back down to this very formidable trend line that has been here again since 2021. And if it goes down, prices of everything go down, and that's the recession, that's the disinflation, deflation, etc. Lastly, also wood continuing to drop below any kind of previous trend line that it didn't really find any bounce here at this previous pivot low here, and just going down, down. If there were bulls in risk assets, I would expect them to be coming out of the woodwork a little bit here, and they are nowhere to be seen. Maybe, I don't know. Don't know what's going on. I'm very confused about long rates going up here, and we'll see what happens. It's very exciting times in markets right now, to say the very least. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.